Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the weekend edition of Bloomberg Businessweek. It's a special edition of Bloomberg Businessweek. I'm Tim Stenovec, and over the next 2 hours, we'll take a look at some of our favorite conversations from the Milken Institute Global Conference in Allaire. Over 4,000 attendees convened at the Beverly Hilton for this year's conference to hear from some of the thought leaders and industry leaders around the world. We'll hear insights from C-suite executives and global leaders on everything from the climate crisis, the latest innovations in tech and media, as well as in-depth discussions on the state of the global economy. On the way, we'll hear from Marc Lipschultz, co-founder and co-CEO at Blue Owl, about the world of private lending.
Our DNA is about delivering lower-risk alternative products and generating really attractive returns.
Minneapolis Fed President Neel Kashkari for a look at the Fed's inflation fight.
So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
And Marc Attanasio, co-founder of Crescent Capital and chairman and principal owner of the Milwaukee Brewers, to dive into the intersection of sports and finance.
The group of owners could maybe manage the PGA more effectively.
All that on the way on this special edition of Bloomberg Businessweek, the weekend show, as we look back at this year's Milken Institute Global Conference in LA. But we start with a conversation about the state of the global economy. Carol Massar and our TV colleague Romaine Bostick sat down with Ron O'Hanley, Chief Executive Officer at State Street, on why he sees strong resilience in the global economy and why he thinks the U.S. is leading the way in sustaining it. Here's that interview.
You're actually fresh off one of the inaugural panels here at the Milken 2024 conference, a panel that was ostensibly really about the future of capital markets. And I sort of wonder, what exactly is that future going to look like? A lot of people look at us right now and say, we're on the precipice of something new.
Yeah, I would actually be much more optimistic about that. And before talking about the future, let's just talk about the recent past. I mean, if you think about what the world has been through in terms of the challenges it's faced, and any kind of challenge in the real economy translates to the financial economy. So we've had a pandemic, a once-in-a-century kind of pandemic, and we've also had ground war break out in Europe. And if you think about how capital markets have actually adapted to that, how you've seen underlying economies repair themselves, and again, the capital markets are very much a function of what goes on in the real economy. And you've seen, I think, extraordinary resilience in the real economy relative to what any of us would have expected.
What do you think was behind that resilience?
Not to sound jingoistic, but I think a lot of it was the U.S. led the way in terms of certainly in the repair of supply chains. I mean, what we were talking about in the middle of 2020 was the potential for this going on for 4, 5, 6 years. And the rebalancing would take that long. And in fact, really led by U.S. corporations, but also just large corporations around the world. It was really led by large companies figuring this out and saying, what do we need to do here?
You know, it's interesting that you bring that up, Ron, because if you think about the pandemic, global companies are rethinking their supply chains, and that has led to a new kind of investable idea. Walk us through kind of the new investable ideas coming off of the pandemic and just a lot of things being different.
Well, let's just stick with supply chains for a moment. I think that maybe with globalization, we went a little bit too far because supply chains became highly, highly optimized with very little built-in, if you will, slack, or for that matter, capacity for the unexpected. So what you're seeing now is really a much more resiliency being built in supply chains. Instead of having single source, it might be double source, triple source. You're seeing some activities being brought back to countries, reshoring. And it's not so much those aren't political statements as much as they are, you know what, we really ought to have a little capacity in whatever country, here in the US, here in Germany, here in the UK. And then finally, you're seeing opportunities being created for other countries.
Right.
Where it may be that a country like China had it all or had a large portion of it. And China's not going to lose everything, but you're starting to see other countries in Southeast Asia. All of these represent investment ideas.
We're seeing a lot of more things shift into like South America, Latin America. One thing I want to ask you, we were all focused over the annual meeting out at Berkshire Hathaway and Warren Buffett. Warren saying Wall Street creating kind of a casino-like atmosphere. He's talked about this before for investors. Do you agree with that assessment, or how do you see it?
So I think there's a concern about market valuations, and it's really a concern about a relatively small number of companies that are seeing lots of valuation expansion driven by things like AI and the belief of AI. So a couple things I'd say about that. If you take the S&P 500 index, right, which is cap weighted and just equal weighted, you actually say it's actually not that overvalued. And by the way, there's opportunities in lots of other companies, right? You were talking about 7 companies in the S&P 500. So that would be point number one. Point number two, which I do think we do need to think about. I'm old enough to remember the advent of the internet. And if you think about the mid to the late...
Not that old, actually.
If you think about the mid to the late 90s, there was that same kind of excitement, same kind of exuberance around a few companies. The internet was going to change everything, and it was going to change everything right away. And then 1999 and 2000 came. And we could find ourselves in a situation like that again, because the hype of a technology oftentimes isn't met by the actual implementation of it. So if you ask me, what do I believe? I think that artificial intelligence in all of its forms will be a fundamental game changer for many industries. Is it going to happen overnight? And is it going to kind of reflect the valuations that you're seeing in a few companies? Probably not. None of these things were ever straight lines. I mean, remember, it was the internet's going to change everything. 99 and 2000 came, we realized there's a lot of stupid companies out there. Why do we have these companies? And then 10 years later, it had changed everything.
Right.
So it was really it wasn't an if, it was a when. We might see the same kind of thing in artificial intelligence.
Another big change out there is the importance of the retail investor. Obviously, State Street has kind of made its bread and butter in the institutional space.
Yeah.
But you made a lot of big strides right now in the ETF space and more products targeted towards the retail set. Is that going to continue?
Well, I think it needs to continue because and that's typically the way things have worked over time. I mean, if you think about going back, the mutual fund is 100 years old now, right? Before the mutual fund, it was only the very affluent that could participate in these markets. The mutual fund enabled it for the retail investor to do that. Where the big gap now remains in privates. I mean, if you think about just private credit, for example, private credit represents half of all credit origination in the US, yet the ability for the retail investor to participate is low. So we do have to think about this, and where the real unmet need is, in my mind, as it becomes to the democratizing of privates, is in the retirement space. I mean, we're all defined contribution investors.
Right.
I'm sure you do the same thing that I do. I think about it once a year, you set it and you forget it. That is the definition of somebody that ought to get an illiquidity premium. So in my mind, some of the biggest reform that needs to be made is how do you enable the incorporation of private investments into traditional defined contribution vehicles.
Do you feel like...
Do you think regulators will allow that?
So I think it's a combination of regulators, but it's also, right now, if you think about the average defined contribution trustee, what he or she is worried about is being sued. And being sued for the products are inappropriate or the fees are too high. I mean, fees by themselves don't mean anything. You have to look at what's the after fee return over time. And that's where I think the analysis needs to be done. And I fear that we're in this situation that over concern about lawsuits, retirement trustees are too reluctant to actually incorporate these products into there.
Real simple, and kind of playing off of what Romaine is saying, like, is there enough transparency in the private credit world or the private space at this point for you to feel comfortable about it kind of being available to a lot more investors at this point, retail investors?
And that's a legitimate concern. I mean, I think there's plenty of transparency for the core investors now, for the institutional investors. And right now, technology is enabling look-through into portfolios. I mean, we actually provide some of this technology for institutional investors where they may be LP investors in 10, 20, 30 different LPs, and we're enabling them to look through. We have to make that kind of technology available to the retail investor too.
I have another question, though, on regulation. I mean, you got dragged before Capitol Hill with the other big bank CEOs. I think it was back in December.
Right.
There's a lot of talk about the Basel III endgame, the additional capital requirements that most people think are going to come. And you guys seem to paint a pretty bleak picture if those rules, at least as written now, go into effect. Do you still feel that way?
Well, I think if you think about what Basel III endgame is about, it literally is an endgame on a process that started well over a decade ago to basically level the playing field. I think some of the rulemaking in the U.S. lost sight of that and became focused almost exclusively on what should we do about raising capital levels in banks. And I think there it just needs to be done around, one, with an eye towards what's happened in the past, and two, what are the new risks that we're facing? So, I think the Fed understands this, and the talk of a reproposal is probably right. And remember, the world changed even as this rule was coming out, right? Because we saw the activities and what happened a year ago, back in March, April of last year. We're seeing what's going on in commercial real estate. So I think there likely should be and needs to be a leveling up amongst different kinds of banks. And we should take a hard look at capital and liquidity, but it should be done in light of everything else that's out there and already been done. Remember, we've been regulating and re-regulating the large banks since 2008, and appropriately so.
Right.
And there were actions that happened that needed to be changed.
But, I'm listening to you and I'm thinking, should we slide into that, the private credit world? But I do think about what are the requirements that they have to just in case.
Yeah.
If something comes undone, everybody says, well, it's on them, but it isn't ultimately, especially if it's a risk ultimately, potentially to the financial system.
Yeah, so the way I think about private credit is that if you're entirely reliant on banks for the extension of credit, banks by definition, given the way they work, they're concentrators of risk, right? You make a loan, you make another loan, you make another loan, sometimes to the sector. So they're concentrators of risk.
Right.
And that's why risk management is so important. That failed in 2008 at some large banks. So from a regulatory perspective, you like private credit because private credit is a distribution of risk. Right, you're pushing it out into hundreds of limited partners, and you're avoiding, or at least minimizing, the likelihood of a systemic failure in a large financial institution.
That's State Street CEO Ron O'Hanley speaking with Carol Massar and Romaine Bostick from the Milken Institute Global Conference in Beverly Hills. Coming up, we're going to hear more of our favorite conversations from this year's conference. You're listening to a special weekend edition of Bloomberg Businessweek. I'm Tim Stenovec, and this is Bloomberg. You're listening to a special edition of Bloomberg Businessweek, highlighting some of our favorite conversations from the Milken Institute Global Conference in Beverly Hills over this past week. I'm Tim Stenovec. Carol Massar and Romaine Bostick were on site this week for a lot of great conversations at the Beverly Hilton. Still to come, we'll talk crypto with Jeremy Allaire, the CEO of Circle.
Stablecoin laws in particular are key because once you have those, then corporations, households, financial institutions will know how to use this, how to treat it.
And hear from media mogul Byron Allen to get his thoughts on the ever-changing media landscape, including some big recent headlines about Paramount.
There's plenty of capital. Just in this lobby alone, there's about $80 trillion looking to invest in something. As a matter of fact, I can step off this podium and raise another $30 billion in about 5 minutes.
All that and more, but first, an important conversation on sustainability. Global investment in the low-carbon energy transition surged nearly 20% last year. That's according to Bloomberg NEF. And for good reason. The rise of AI and the massive amounts of energy needed to power that new technology magnifies the importance of finding sustainable and clean ways to power our world. At the conference, Carol and Romaine spoke to Pooja Goyal, CIO of infrastructure at the Carlyle Group.
Tell us about this space. It does feel like there's a lot going on. We bring up AI, and the energy demands are just magnified many times over. Tell us a little bit more broadly about kind of the investment needs in this space.
You know, what you're seeing right now in the infrastructure space is a significant shift in the demand for hard assets or infrastructure assets. You know, take Milken, for example. You have some fantastic macro content here. The opening session this morning was with the IMF. And guess what? In the first 3 minutes, you were talking about energy transition. And the session actually concluded talking about energy security and the supply chain. So if you take a step back, you're in the middle of an energy transition, which is a supply-side dynamic. Compounding that dynamic is now this new demand for energy. What we are seeing at the micro level is actually very consistent with what you're hearing about at the macro level. There's a real convergence that's taking place between this asset-light, high-growth, very glamorous technology sector suddenly converging with this capital-intensive, development cycle-oriented infrastructure sector. All of this investment in technology and AI is going to require a significant amount of investment downstream in data centers as well as power generation capacity.
It's amazing how AI has upended, right, the technology space in terms of capital intensity. Having said that, all the power that's needed to run artificial intelligence and all the computations that's needed, can we do it in a sustainable way, or we're going to have to rely on some of the old fossil fuel burning, if you will, ways in terms of energy?
Look, we tend to be very thoughtful as we think about investing in the energy transition at Carlyle.
Right.
In fact, one of our chief energy strategists, Jeff Curry, has recently published a lot of research on this topic as well. And Harvey Schwartz also said that, look, we have to be very practical as to how we approach the energy transition. You can't just flip a switch and go green immediately. We have a thesis-driven approach to investing at Carlyle, and we knew 4 or 5 years back that there was going to be a significant demand for clean and sustainable energy sources. We actually didn't like any of the existing investment opportunities that were available in the market. So any of the incumbents, we didn't like how they were organized to take advantage of that growth opportunity set. So guess what? We started our own company from scratch.
Right.
It's called Copia Power. We started with 4 employees, and as of the first quarter of this year, we are developing 20 gigawatts of power generation capacity in the US. What's interesting about this company is not only generating power generation capacity, it is actually building that capacity in areas where you can also develop green data centers. So now you're talking about a paradigm shift. You're talking about locating data centers to where you're actually going to produce power. And that's the forward thinking that you tend to see in the private markets or in the private equity, infrastructure equity space.
The Copia deal was a big one, and it got a lot of attention. You can't do what you do, whether it's that deal or the other ones, without an eye on regulation. When it comes to regulation and how disjointed regulation is around this country when it comes to power generation and power sustainability here, how do you navigate that? Because you're trying to sort of build something that in one state might be different than another state, when federal regulation that could easily change, I don't know, a year or two from now.
I think you're so spot on, which is why you need to focus on the micro and you can't just simply focus on the macro. Look, investing in these kind of infrastructure assets requires time, patience, but a lot of deep sector expertise. You know, regulatory insights is one thing. You need to have capital markets expertise, development expertise, permitting, procurement, and obviously commodity markets expertise as well. The view that we take at Carlyle is that you have to work in collaboration with your regulators as well as your public and private sector participants. It has to be a collaborative approach. That has to be with policymakers as well as utilities and grid operators. Remember, that is a significant bottleneck right now. You know, you're hearing about transmission constraints, even for the build-out of new data center capacity. But we just have been very good at working hand in hand with local constituents as well as public market stakeholders that have an important seat at the table. One fantastic example of that is how we're redeveloping the international terminal at JFK Airport.
Yeah.
You know, I flew out of JFK.
We have to thank you.
We all thank you.
And look, it requires patience. It requires a lot of capital. This is a project we got involved in 2019.
Right.
And we worked with the Port Authority of New York and New Jersey through the pandemic. That was incredibly challenging. And today, you have a new terminal that's getting built. It is the international terminal at JFK Airport. But yes, you absolutely need to have those insights. But you also need to be practical, and you need to be humble, and you need to approach those projects in that way.
A little bit later, we have to ask you what you can do for LAX, because they need some help out here. In all seriousness, though, when I hear about the project JFK, or even with Copia, you talk about the complexity of doing that. Yes. But part of that complexity is also you're exposing yourself to a lot of supply chain risk. And we know that supply chains have been disrupted a million times over the past 4 or 5 years, from the pandemic to the trade tariff wars and everything else. How do you deal with that?
So we actually think it's an important tool that we have in our toolkit at Carlyle to drive value creation in our portfolio companies. If you think about infrastructure as an asset class, what are the levers you have to drive economic outcomes? Building your assets as cost effectively and efficiently and on time as possible is important. So managing that supply chain, both from a cost perspective as well as certainty of time perspective, is important. We have some very good strategic relationships globally. And the supply chain is a global supply chain. I think it's very easy to say that you're going to onshore the entirety of your supply chain. It depends on how further upstream you go in your supply chain. So you have to be very strategic about it. And we think that it's an edge that we have right now.
Pooja, how much does politics play into all of this? And I think about the upcoming November election. And does that change anything in terms of the sustainable investment initiatives that certainly the government has had its hand in it pretty aggressively? Or will the public, or will the private markets and private companies just continue that march towards more sustainable energy uses? How do you see it?
It's a completely fair question. Look, the Inflation Reduction Act was extremely meaningful, but you cannot call all politics the same. You have federal policy. You also have state-specific policy as well as mandates. And look, we have fantastic insights. We're headquartered in Washington, D.C. We work very closely with our stakeholders, and those include policymakers both at the federal level as well as the state and local level. What I go back to is the fundamentals here. There is a need to invest in this infrastructure. That demand is coming both from the private as well as public sector. There simply isn't enough public policy or public capital that can actually fill the gap. There's plenty of room for private capital to actually play a very important role here. And candidly, when I take a step back and I always think about, relative value comparison between what you're seeing in the public markets right now, and I'm talking about the equity or the credit markets right now, versus the results you can achieve in private markets, I actually think that private equity has a very important role to play here, simply because we're not managing outcomes to a quarterly basis. We have the ability to be patient as well as strategic with our portfolio companies and drive the right outcomes there.
All right, Pooja. All right, this is now time for the big, broad questions. Normally, Carol does this, but I'll pick it up.
I gave it to you.
Thank you. What is kind of the big risk, though, that you're focusing on over at Carlyle? I'm talking about longer term.
Look, I always tend to approach everything from a commodities market perspective because they're just important, right? Even if you think about what could be a constraint to all this investment that's going into generative AI and technology, it's commodity, it's energy. So being long energy is incredibly important from our perspective. But what could cause disruptions in energy markets? Obviously weather-related patterns, but obviously geopolitical uncertainty as well. So that is a dynamic that we're very focused on, and that can have an impact on supply chains and ultimately even monetary policy. So we're very focused on all of these variables as we think about risk management across the entirety of our portfolio.
That's Pooja Goyal, CIO of Infrastructure at the Carlyle Group, speaking with Carol Massar and Romaine Bostick this past week at the Milken Institute Global Conference in Beverly Hills. Up next, we turn to the intersection of sports and finance with Marc Attanasio. He's co-founder of Crescent Capital and chairman and principal owner of the Milwaukee Brewers.
The Strategic Sports Group was organized by John Henry, who is the chairman of the Red Sox and more broadly Liverpool and Fenway Sports Group. So he had an idea that a group of owners could maybe manage the PGA, bring some management skills and manage things more effectively than a private equity firm could or a big broadcasting firm could, to pick the types of, or a large family office to pick the types of bidders that are in the process. And ultimately, he and Arthur Blank and Steve Cohn actually, the three major investors, sold that vision to the golfers. And we're going to try to manage, there's some basketball owners in it as well. There's 7 or so of us who own teams. I'm sort of the small market representative, but we can bring management of a league to a different level. And I think we made some headway on that.
You're listening to a special weekend edition of Bloomberg Businessweek as we bring you some of our favorite conversations from the Milken Institute Global Conference in Beverly Hills. I'm Tim Stenovec, and this is Bloomberg. Welcome back to a special weekend edition of Bloomberg Businessweek. We're taking a look back at some of our favorite conversations from the Milken Institute Global Conference in LA. I'm Tim Stenovec. Despite some uncertainty in recent years when it comes to the markets and the economy, one industry that seems to keep doing better is, well, sports. Marc Attanasio is Crescent Capital co-founder and Milwaukee Brewers chairman and principal owner, and he's in a really interesting position. As someone who is part of a firm that has around $40 billion in assets under management, and someone who's doubling down in sports with his baseball team. Carol and Romaine got a chance to catch up with Marc Attanasio.
What's easier right now, investing or sports?
I was going to give a pretty glib answer and say investing, and I thought that was going to then bring some bad juju to our investment business, which has gone very nicely in this period.
Well, let's talk about this. You, several years ago, big Bloomberg story, we talked about you and some comments you said about the golden age, an era of credit, private credit. Where are we? Is it still the golden age? Has it matured a little bit? How do you see it?
Well, it's matured, and I think that's a good thing when markets mature. There's many more participants, and so there's less, in one sense, there's less inefficiency. At Crescent, we like to invest over 33 years in things that are inefficient, but there's plenty of opportunity, in the world right now, and I think some of the stability we've seen, in the capital markets and interest rates and so forth is enhancing that.
Well, we'll talk a little bit about the interest rate picture, because a couple of years ago, everyone was pulling their hair out about all of those rate hikes. And then, of course, we started, I think, late last year, everyone was talking about rate cuts. Now we're just kind of where we are. You can live with that. You can live with 5.25%, 5.5% on the Fed funds rate.
Oh, absolutely. And, a lot of the guys in sports, when things go wrong, that's the challenge in sports. You really can't manage what goes on in the field. Or I'm an investor in English football now also, Norwich City Canaries, what goes on the pitch. You think you can figure out in companies quarter to quarter privately what goes on. And we can manage through 5%. It actually, we're now making loans at over 10% interest rate. That's better for us than when we had low rates, and our investors for the same credit basically were earning 7%. Concerns with inflation and rate hikes were such. Jamie Dimon was talking a lot about if rates went to reference rates 7+%, you'd have a number of defaults.
Yeah.
It's true. But in this, we've seen very few defaults in any market. And high yields.
Does that continue? Forgive me. Does the low level of defaults, does that continue, you think?
I think it does. There's always a tail risk at the end.
Yeah.
And maybe secular risk by industry. But we see growth in our companies to this day. There was a risk at one point of lowering rates too fast and tipping into a recession. If you have a recession now, it should be manageable because the Fed's been calibrating really well.
I want to talk about his investments in sports.
Obviously,
Milwaukee Brewers here in the U.S., but you mentioned, let's go to the U.K. You mentioned the Norwich Soccer Club. I think you were referring to it. I don't know if you saw this story. The New York Times did a great story about how all the folks in the U.K., they're upset about all these Yankees coming in to there and buying up their teams here. But it's actually a serious thing, because they're saying, hey, it's changing the complexion of how we root for sports. Obviously, your mission is to broaden the sport here. How do you balance that out?
And that's a challenge. And by the way, they mentioned the championship clubs that are looking to move up, and we're one of those 4 in the playoffs. And I did not get mentioned. I was happy to not be mentioned. It was announced just a week ago that we're co-majority owner with Delia Smith and Michael Wynne-Jones, who's long-time celebrity chef. She sold over 30 million cookbooks. So I'm going to let her handle the love.
Yeah.
And one of the things we see in Milwaukee is I want to cherish what the fans enjoy, so we wouldn't try to change too much. It's one thing to do it in the larger markets, which you've seen effectively, but in a market like Norwich City, which is a city of 200,000, a county of 1 million, where everybody grew up passionate for this team, we're going to go slow in that regard.
Golf. You were part of a team that had a recent investment in the PGA. Talk a little bit about what was behind that investment. Why?
The Strategic Sports Group was organized by John Henry, who's the chairman of the Red Sox and more broadly Liverpool and Fenway Sports Group. So he had an idea that a group of owners could maybe manage the PGA, bring some management skills and manage things more effectively than a private equity firm could or a big broadcasting firm could to pick the types of, or a large family office to pick the types of bidders that are in the process. And ultimately, he and Arthur Blank and Steve Cohn actually, the three major investors, sold that vision to the golfers. And we're going to try to manage, there's some basketball owners in it as well. There's 7 or so of us who own teams. I'm sort of the small market representative, but who can bring management of a league to a different level. And I think we made some headway on that.
Well, I think it's great to see golf. I'm from a family of golfers, so it's great to see golf coming back. Thank you so much, Marc. Really appreciate it.
I always appreciate getting invited, and it's good to see you all.
That's Marc Attanasio, Crescent Capital co-founder and Milwaukee Brewers chairman and principal owner, speaking at Milken with my colleagues Carol Massar and Romaine Bostick. And from the world of sports and finance to the world of crypto. Fair to say, volatility is a constant when it comes to crypto. And at Milken, Carol and Romaine sat down with Jeremy Allaire. He's CEO at Circle. It's a company that manages USDC, the stablecoin. They talked about the state of crypto.
Jeremy, great to have you here on the program.
Thank you. Great to be here.
And you know, some of the optimism that we're seeing around stablecoins has less to do with stability coming out of the regional banking crisis, but about the embrace that we're starting to see from a lot of the payments companies, whether it's PayPal, whether it's Stripe, a few others, really saying, not only do we want this, we need this.
Absolutely. I mean, we're really seeing this market developing, not just in the US, but around the world. We're seeing top global super apps like Grab. We're seeing major neobanks like Nubank in Brazil. You know, the most successful fintech of recent years in the United States, Stripe, announcing that they're rolling out USDC payment acceptance for their merchant base. BlackRock, who's issuing a tokenized asset, a tokenized government money fund, enabling USDC transfers from that fund using smart contracts. So we're seeing some of the biggest institutions in the world embracing USDC.
There's a lot of momentum right now, but I have to ask, why did it take so long to get that momentum? Because everything that's going on with stablecoins right now, I heard this story several years ago, but we never really saw the mass adoption.
Well, people would always ask me, when's mainstream adoption going to happen? What are the things that are there? And I've always said, you need regulatory clarity. You need the technology to become much more scalable and usable, right? And then you need the people, the mainstream applications that people are going to be interacting with this through, whether you're a business accepting a payment or an end user. You need those to connect up to that. All three of those have been happening. We're getting regulatory clarity on payment stablecoins all around the world in almost every jurisdiction. We have a payment stablecoin act that's at the proverbial 1-yard line here in the US. You've got the infrastructure now finally at a place where you can handle large amounts of transactions very inexpensively, and you can kind of make the crypto of it all become something in the background so users can be interacting with more familiar products and applications as opposed to needing to know a lot of the technical jargon and complexity of what you kind of saw in the last cycles of this technology.
Jeremy, I so get it, like, if you build it, they will come. I get it, and you've got all the pieces coming in place. So what can you tell us about the velocity and the utilization of actually people using it and that volume building?
Well, since we launched USDC nearly 6 years ago, obviously it's grown tremendously. The amount of volume, the transaction volume, we've handled, I think, now over $14 trillion of transactions using USDC on blockchains. One of the really key shifts, though, that we've been seeing, in particular over the past couple of years, has been growth in cross-border settlements. This ability to take a digital dollar, transact it anywhere the internet exists, small and medium enterprises, households, firms, really seeing the benefits of this and leapfrogging kind of the legacy banking system to do that. So we're seeing a lot more growth internationally. We often talk about this, but the significant majority of the holders and users of USDC are not in the United States. They're in markets like Latin America, Southeast Asia, and other markets. And so that's a really significant and valuable driver in the adoption of stablecoins right now.
Having a daughter overseas, yes, I could understand how it could make it much easier and cheaper. Having said that, the regulatory component of it, reading over the weekend that there might be some stumbling blocks. We kind of get so far, it feels like sometimes with legislation, and then don't get across the line, if you will. What are your expectations and why the regulatory component is so important to your business and the utilization of it?
Well, the first thing to note is, we have always been a regulated operator. We're regulated from sea to shining sea in the United States. We have major, prudential regulators like New York. We've got regulators in Singapore, in the UK, in the European Union. So we're a well-regulated company. But stablecoin laws in particular are key, because once you have those, then corporations, households, financial institutions will know how to use this, how to treat it. So everywhere in the world, in major markets, there's now stablecoin laws in Japan. There's now stablecoin laws in the entire EU. And in fact, the European Union is regulating digital dollars before the United States. That will go effective June 30th. In the United States, the Payment Stablecoin Act, there's been a huge amount of work on that, very bipartisan, the administration, the agencies, across the aisle. So everyone sees the critical need here across national competitiveness, national security issues, and consumer protection. And so I think that's there. It's really, at this point, a when, not if. Yeah. And what's the right legislative vehicle, given that our Congress doesn't have a lot of ways to put things into law?
That's what I'm curious. When is the win? I mean, I know you have some big champions in Congress. Patrick McHenry's obviously done a lot on this here. But do you think there is enough bipartisan support to move a bill soon, or is this something we're going to still be talking about?
Well, you're hearing, I think, very positive things from Senate leaders, from Senate banking leaders, from, there's a lot of reporting on this, and these are across the aisle. You're seeing this interest, Republican and Democrat. So I feel like that's there. And again, it's just, the complexity of what are the vehicles that become available for laws to kind of go into effect. That's really where we are.
That's Circle CEO Jeremy Allaire speaking with Carolyn Romaine at the Milken Institute Global Conference this past week. Coming up on the next hour of this special weekend edition of Bloomberg Businessweek, we hear more from this year's Milken Global Conference in Beverly Hills. I'm Tim Stenovec. Stay with us. Today's top stories and global business headlines are coming up right now.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
Welcome back to the second hour of a special weekend edition of Bloomberg Businessweek. I'm Tim Stenovec. We're taking a look at some highlights from the Milken Institute Global Conference in LA. Over 4,000 attendees convened at the Beverly Hilton for this year's conference to hear from leaders in government, business, academia, and more. Carol Massar and Romaine Bostick were on site to speak with many of those folks, and their conversations touched on everything from the climate crisis, the latest innovations in tech and media, as well as in-depth discussions on the state of the global economy. Coming up this hour, we'll hear from Minneapolis Fed President Neel Kashkari for a look at the Fed's inflation fight.
Second half of 2023 surprised us at how rapidly inflation fell. It seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
And we'll hear from Marc Lipschultz, co-founder and co-CEO at Blue Owl.
The private markets, we've been providers of capital all through COVID, all through when the Ukraine war started, inflation raged, when we had problems in the regional banks. Every step of the way, Blue Owl provided credit. And the public market is the one that's become the high amplitude in and out provider.
All that and more on the way, but we kick off the hour with a conversation about the ever-changing media landscape and an independent media mogul who's looking to grow his empire. None other than Byron Allen.
Are you interested in buying Paramount? And if so, at what price?
You know what? We remain interested. We think it's a phenomenal asset. And we think Sherry and our management team, they're well positioned to continue their path, or if she wants to sell, we're happy to help. And I have a lot of faith in Sherry Redstone, and I have a lot of faith in George Cheeks and Brian Robbins and Chris McCarthy. They are excellent managers, and if she decides that's the path she wants to take, have them run things, that's great. If she's still interested in selling, we are very interested in sitting down to figure out if we can get something done. A lot has occurred over the last 6 to 8 weeks. Events that we're not used to seeing happen so rapidly. But we do have strong interest in buying all or some of Paramount Global.
Do you think your bid can be competitive, both in terms of what it offers strategically as well as the financing to do it?
You know what? Capital is not the issue. There's plenty of capital available to support our bid and to buy the asset. The real commodity here is certainty of close. And the great investor Mario Gabelli said it best. This deal will live or die at the FCC. My advice would be to walk into the FCC with somebody that is FCC approved, somebody who owns and operates television stations.
Do you think Sony can do that?
Well, when you are a foreign owner, that's tough to own television stations. I think you can own up to 20%. Where they don't allow that. So we've invested about $1 billion buying ABC, NBC, CBS, and Fox affiliates around the country. We are broadcasters first, and we are FCC approved. And that is the key to this deal, approval, regulatory approval. There's plenty of capital. Just in this lobby alone, there's about $80 trillion looking to invest in something. As a matter of fact, I can step off this podium and raise another $30 billion in about 5 minutes. Just go talk to her, him, and her, and we're over. So capital isn't the issue. Approval is the commodity. And that's the thing that everybody needs to be mindful of. You want to be respectful of the process. I don't think you want to go into DC saying, I've never owned and operated television stations. I think that's important.
Byron, having said that, it sounds like you're pretty far along in the process. Do you have bankers lined up? What can you share with us in terms of who you're working with when it comes to, as you say, lots of capital out there. So who are you working with in terms of lining up the financing to actually do a deal?
Well, that I can't share with you. But I will tell you this, that the capital is very much available, not just to me, but others that are skilled in this area of buying and running media companies. And I think that's what's going to come out in the whole process. What you don't want to do is tie up the asset for a year or two and not get approval.
How far along are you, though, in actually the specifics on a deal in terms of getting something done?
Quite a bit of our capital has already been investment committee approved. So we're good to go in that regard. I think we wanted to be respectful of Skydance and Redbird Capital. They had a 30-day exclusive. And so we wanted to see what the story is and confirm whether or not that exclusivity has expired. We're not, a very smart banker said to me, Byron, you don't have to do a thing. All roads lead back to you. Because there are assets there that we want that others don't. We want the linear networks.
Why?
I believe in the linear network business. I think it's the majority of their revenue and their EBITDA. There are folks.
But that's the contrarian approach. Everyone's trying to get rid of their linear operations.
I bought the Weather Channel.
Why can't you make it work?
I bought the Weather Channel 6 years ago, and they couldn't. I bought it from Bain, Blackstone, and NBC Universal. They couldn't wait to give me the keys. And thank you very much. In those 6 years, we pushed up the top line revenue and we pushed up the EBITDA, and we're running the Weather Channel at a 50% margin. So we're very comfortable in the linear business.
That's Byron Allen, chairman, CEO, and co-founder of Allen Media Group. And that was at the Milken Institute Global Conference in LA, and he was speaking with Carol Massar and Romaine Bostick. From a media mogul looking to find new opportunities to a firm on Wall Street looking to do the same when it comes to alternative investments. Stephanie Drescher is Chief Client and Product Development Officer at Apollo Global Management. She spoke with Carol and Romaine from Milken.
And you guys have never been shy about chasing opportunities, and we've seen much more of an opportunity now with individual investors and even going down the ladder, not just the ultra high net worth individuals. Maybe one day even somebody like me will have a shot at investing in these things.
We absolutely see an opportunity for the individual investor, for the family to be able to benefit from the excess return that institutions have for decades. And when we think about being able to deliver the institutional quality offerings to the individual, we have expanded, we've innovated. In the last few years in particular, taking the same rigorous investment approach and the excess returns that you can get from alternatives and packaging them in ways that are designed deliberately for the family and the individual.
How hard has that process been, if at all?
You know, it's a big commitment. It's actually pretty massive if you're going to do it well, because when you step back, we want to ensure that we not only deliver the investment performance, which of course is core to what we do at Apollo, but we also want to ensure that we're taking a full product suite view. We want it to be holistic, and being able to create portfolios that cross private investments. At the same time, we want there to be education and advisor and client service, and frankly, the whole holistic view of the client. So it starts at the top. You need the CEO on down to be committed to the wealth effort.
Well, dig a little bit deeper into that in terms of the precautions that you want to make sure that investors who are getting in this space understand what they are investing in and what you guys are doing on your side to mitigate risks, but also provide certainly returns.
The partnerships that we have are critical. We are working with private banks and wires and registered investment advisors to work with the advisor community, ultimately to ensure that they understand all of the benefits and considerations of private investments as they speak to their clients about portfolio construction. But what's interesting is that historically, I think people have thought of the public markets as safe and private markets maybe as riskier. In reality, I think as we look at correlation and volatility and just the results across, let's say, public active managers, it's interesting, those active equity managers in the public realm have failed to meet the benchmark 93% of the time over 15 years. So when we look at the potential nature of the public markets, what we realize is that they are safe and risky at the same time that the private markets are as well. And it's really construction of the portfolio that matters.
I guess I would say, though, Stephanie, to that public markets, right? Every day there's tons of information that come out. There's folks like us who are reporting on it. And the markets act as kind of a clearing mechanism in a big way in terms of getting any bad news through it, or really a lot of transparency. How do you bring that to private credit?
Look, we believe in transparency in what we do as a firm and certainly with our investors, and we lead with it. Our different offerings that we have that are often registered have nearly the entire portfolio available, if not 100% of the portfolio available to investors. So we're very confident that our construction of the portfolio and the diversification that we bring as, frankly, a complement, if not a replacement, to a piece of the fixed income portfolio that they may have in public markets, or frankly the same for being a complement in their public equity portfolio with private markets exposure.
One of the challenges as more people allocate to private strategies is this idea of the duration of those investments, which are a lot different than for public investments, as you know. And certainly for a retail investor that's used to being able to sell whenever they want to sell or buy whenever they have to buy, that requires a little bit more hand-holding, or at least a little bit more of a, therapist couch, if you will, to sort of prepare them for that. I mean, how do you sort of sell them on that idea?
Look, I think the promise of alternatives is to deliver an excess return above the public markets. The reality is that there is an element of additional illiquidity that one does accept in order to achieve those excess returns. Now, in many instances, that could be quarterly or potentially even in monthly segments. But we absolutely do look at the underlying liquidity needs of the client. On the flip side, when we speak with advisors on behalf of their clients, it's very rare for us to find a client that needs all of their liquidity tomorrow. And if you take kind of one of the most extreme cases out there, kind of a 401k, let's say, that is today managed on with a very heavy daily focus, whether that's mutual funds or ETFs. But in reality, the average duration, to your point, could be over decades, if not 50 years. So making sure that an investor has access to solutions that allow them to forego a bit of the liquidity, but generate the excess return that they can deserve.
That's Stephanie Drescher, Chief Client and Product Development Officer at Apollo Global Management. She spoke with Carol Massar and Romaine Bostick at the Milken Institute Global Conference in LA. You're listening to a special weekend edition of Bloomberg Business Week as we bring you highlights from Milken. I'm Tim Stenovec, and we have much more on the way, including a conversation with Neel Kashkari of the Minneapolis Fed. I'm Tim Stenovec, and this is Bloomberg.
Get the latest news at the click of a button inside your car. The new Bloomberg Business app, now featuring Apple CarPlay and Android Auto. All your favorite Bloomberg radio shows at your fingertips. Download it free in the Apple App Store or on Google Play. This is Bloomberg Business Week with Carol Massar and Tim Stenovec on Bloomberg Radio.
You're listening to a special weekend edition of Bloomberg Business Week as we bring you highlights from the Milken Institute Global Conference in LA. I'm Tim Stenovec. Coming up, we'll hear from Blue Owl co-founder and co-CEO Marc Lipschultz.
At the end of the day, the real problems come from mismatches of liquidity. And here in the private markets, what we're doing is matching long-term commitments of capital to long-term uses of capital. That's inherently more stable.
And we bring you a fascinating conversation with a neurosurgeon and neuroscientist who's breaking ground with his work in addiction and dementia.
We need to find solutions, and we need to work together between industry, public, private sector. In the same way we came up with the solution for COVID, with the COVID vaccine, we need to build teams together that are accelerating the pace of discovery.
All that on the way, but first, all eyes on the Federal Reserve and the path for rates this year. Carol Massar and Romaine Bostick got a chance to sit down with Neel Kashkari. He's president of the Minneapolis Federal Reserve. Their conversation at the Milken Institute Global Conference in LA.
There's been a lot of talk about how persistent inflation has shown itself to be. You were pretty early on, at least among Fed members, of saying, don't get too ahead of yourselves and talking about cutting rates. A lot's changed, at least from the data that we've gotten over the last, 3 months or so. Has that changed your view as well about staying where we are?
Well, the second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it's stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time. I think we're in a good place right now. Labor market is still strong. We can take our time to get more data to see if disinflation is going to continue. And if it does, great. If it doesn't, then we need to take that on board.
What is the complexion right now of disinflation? What actually drove us, at least down to the level where we're at right now?
Most of the gains that we saw last year were supply side improvements. Supply chains getting better, Americans coming back to work, a lot more workers entering the labor force. That's really positive. I don't think monetary policy actually brought demand down that much. And so most of the gains were because of the supply side. Now the question is, if monetary policy has to take us the rest of the way there, is it tight enough to do that? I wrote an essay today on our website raising that question, and I'm not sure how tight monetary policy is. We need more data to assess it.
How do we know that the disinflationary process has still some ways to go? Or how do we know that maybe this is it? This is the new normal?
Well, it's not the new normal because it's 3%, and the Fed can and will achieve 2%. The question is, if disinflation is still underway, then maybe it'll continue on its own, and we can then take that on board. If we need to hold rates where they are for an extended period of time to tap the brakes on the economy, or if we even needed to raise, we would do what we need to do to get inflation back down.
I have to just ask you, though, about 2%. And I know why the Fed stands by that 2%. But I talked to people around the room this week here, and their cost of capital, they're basing that more on closer to a 3% rate. And the idea is they're saying, look, the 2% target, that needs to come up. That's not the reality long-term structurally, and at least not for the folks in this room.
Yeah, I disagree with that. Yeah. I mean, I think that ultimately the central bank, whether it's the Fed or the ECB or the Bank of England, can determine whatever the inflation rate is. And over time, if they conduct their policy appropriately, people will come to understand that, will adjust their behavior. We're committed to 2%. We will get to 2%, and we will get an interest rate environment necessary in order to achieve 2%.
You know, one of the arguments, though, Neel, is that the idea of nearshoring, bringing things back home, building chips in America, they're going to be more expensive than if we were building them overseas. And that is going to be, consistent inflationary pressures longer term. There are some macro forces underway. Why not think that it's got to be above 2%
See,
longer term?
I think those trends are real, but those would suggest to me a one-time increase in the price level, not necessarily an ongoing increase of inflation at a higher level. But we believe, and I believe, that the monetary authority can ultimately long run determine the inflation in the economy, but the rate environment necessary to achieve that may be different depending on these broader macro forces.
So rate cut this year, should we take it off the table? Is it still a possibility?
It's certainly still a possibility. We need to let the inflation data tell us. I think my colleagues and I, we all have a range of views on where the economy is going, but we're all committed to letting the data guide us. And if the data comes in a positive manner suggesting disinflation continues, we'll adjust.
Go ahead.
But is it just housing pressure? Like, you write a lot about housing pressure, and we talk about it. We're talking with a lot of people in the real estate sector. There's not enough supply of houses out there, and that's creating inflation on the housing front. Is it just housing pressures that you guys are really focusing on, or that you're focusing on?
I'm focusing on housing, first of all, because it's traditionally the most interest rate sensitive sector of the economy. And if the most interest rate sensitive sector is not showing as much disinflation as I would have thought, for example, new lease rates appear to be climbing back again.
Yeah.
That's surprising to me. Why is that? That makes me wonder, is policy as tight as I would have otherwise assumed? We are seeing some effect of monetary policy on credit card delinquencies, on auto loan delinquencies, especially for lower credit score borrowers. So it is having some effect, but it's not having as much effect as I would have guessed by now.
I know we have the benefit of hindsight, but you go back to when the rate hiking cycle effectively paused. Do you think that the Fed should have kept going with hikes, meaning additional hikes?
I don't know. I think that there are lags in monetary policy, and we saw such rapid disinflation in the second half of last year. It was a really wonderful scenario. That was real, and that surprised us. And so it's reasonable to say, let's just let that continue. Maybe it'll take us all the way home. It ended up stalling out, at least for a little bit.
Do you feel like you can accurately assess those lags, what those lags are? Because even when you talk about disinflation, you acknowledge yourself, a lot of that is driven by supply side issues and not just monetary policy. How do you assess what the balance is?
Yeah, it's hard.
Yeah.
For example, in the housing market, which we're talking about, we know a lot of Americans refinanced their homes when the mortgage rates were very low. And so they're not feeling the pinch of higher rates because they have not had to refinance. And so that happened. That happened in the late 1970s and early 80s as well. That's part of the lag in the policy process. So we have a lot of data that we look at, and we ultimately have to use judgment to try to put it together.
Speaking of data, growth, we're doing okay. Jay Powell consistently reminds us this is a good thing. We hear it, we feel it here at Milken. Is there the possibility that you don't even have to cut rates at all this year because the economy is strong?
Well, no, you're right. So if inflation moves sideways, and if the labor market continues to be strong, and growth continues to be strong, then I would be in the camp of we shouldn't do anything. Just let this play out for an extended period of time. If, on the other hand, we start to see inflation come back down or meaningful weakness in the labor market, then that might say we need to start dialing back. Or if inflation proves to be more entrenched, we could have to go up.
That's Minneapolis Fed President Neel Kashkari talking to Carol Massar and Romaine Bostick at the Milken Institute Global Conference this past week. And from the Fed to the world of M&A. Anu Aiyengar is global head of M&A at JP Morgan. Carol and Romaine spoke to her about some of the big moves in the space and what to expect for the rest of the year.
Why is the environment now maybe a little bit more amenable than what it was a year or 2 years ago? Is it all just about interest rates?
No, the biggest difference I'd say is certainty, more realistic valuation expectation from sellers, and a bit more, courage in dealing with the regulatory environment. So if I break it down, right? Last year, you didn't know whether interest rates were going to continue to go up. This year, we began by saying they're going down, but we don't know how much and how many times. Right now, it looks like maybe it's less than you expected, but it's still either a stable or declining environment. So that's a positive. There is more realism among sellers in terms of what is the value at which to trade.
Well, I want to expand on that, on the realism, because this was a big issue even a year ago.
It's still
where
an
what
issue.
sellers saw in the value of a company and what the buyers saw in the value of the company were way different. So has that gap closed?
In certain areas it has, or buyers have become smarter in terms of using structure. So one of the things we advise people is to say, if you have dramatically different views, there is a way in which to say, if you're right, I'll pay you more, right? And so that should be sleeves off your vest, because if the company is actually worth more and does better, then it's okay to pay more. Now, it doesn't work all the time, because if you're a very large company buying a smaller company, you don't want to wait to integrate it. So it's not one answer fits all, but one, there is more realism among sellers, there is more confidence among buyers, and there is more structure in bridging the gap. So the combination of all three, you've seen more deal activity.
And then what can you tell us about sectors and industries where you think things are really percolating and you anticipate some more deal activity?
So healthcare continues to be very active. We kind of saw a few years where healthcare was fairly down because everybody was focused on coming up with a vaccine, treatment, testing. That was kind of the focus. And now you see more activity in healthcare. So I'd say that we expect to continue to be active. You've seen a lot of activity in broadly defined commodities, oil and gas, mining. That you'll continue to see in that sector as well. Infrastructure, I expect that to be a pretty busy area. While private equity is still not as robust as it should be, the infra slice of private equity is pretty active. Tech, a little down. And I think the regulatory environment continues to be challenging for tech.
What about in terms of getting exposure to AI? Is there anything interesting in there in the deal environment?
So everyone is trying to figure that out, right?
No, really?
Everybody, right? I'm sure your company, our company, we are all trying to figure out how is it that you responsibly unlock the potential of AI.
Yeah.
And I actually think it's really exciting in terms of what you can do, because literally every industry's future is affected by how you use AI. So we as a firm are doing a ton in terms of looking at different tools, testing, and in terms of deal activity, I'd say it's more broader tech capability where VC-owned firms, strategics are looking to see, can I scale it? Is this a commercially proven business that we can scale? If so, they're willing to make a bet.
That's Anu Aiyengar, Global Head of M&A at JP Morgan, speaking with Carol Massar and Romaine Bostick from the Milken Institute Global Conference in LA. Coming up, more highlights from the conference this past week. You're listening to a special weekend edition of Bloomberg Businessweek with a focus on Milken. I'm Tim Stenovec, and this is Bloomberg.
Miss the top headlines on Bloomberg Radio? Get the latest news when you want it, updated continuously throughout the day with Bloomberg News Now. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app and anywhere you get your podcasts. This is Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
Welcome back to a special weekend edition of Bloomberg Businessweek as we look back at some highlights from the Milken Institute Global Conference in LA. I'm Tim Stenovec. We've been listening to conversations Carol Massar and Romaine Bostick had while they were at Milken with some leaders in business, government, academia, and more. And we've covered a wide range of topics, from sports and entertainment to investing to sustainable energy. Coming up, we bring you a special conversation in the medical world, where a trailblazing researcher is working to eliminate addiction and dementia. Dr. Ali Rezai from the West Virginia University Rockefeller Neuroscience Institute.
What if now we can open the blood-brain barrier non-invasively with an outpatient procedure temporarily to allow much more drugs to get into the area where the problem is? And that can potentially help really accelerate and make drugs even more effective and safer.
That's coming up, but first we hear more from Wall Street. Marc Lipschultz is co-founder and co-CEO at Blue Owl. It's one of the largest private lenders in North America. Here's his conversation with Carol and Romaine.
Let's talk about those recent acquisitions. Not a terrible surprise, but certainly it shows maybe a broader look that Blue Owl is taking at the industry right now.
It's a continuation of the Blue Owl strategy. Look, our DNA is pretty straightforward. Now, we've gotten large, but very focused. Our DNA is about delivering lower risk alternative products. That is to say, it's about protecting the downside and generating really attractive returns, generally with an income component for our investors. That's really the product suite we have. And when you look around that access, that solutions provider is the way we provide capital to deliver that for our investors. All of the things we've done wrap very tightly around that core.
And the importance of generating income, as you say, kind of ties in to the insurance deal, right? I mean, this is basically, I don't want to say a new market, but for a lot of folks, there are finally alternative asset managers really starting to wake up to what you can get out of the insurance space, out of annuities.
Exactly right. Yeah. So from our point of view, having started nearly a decade ago with our business, we had two things we did really early on. We very early on worked on this focus of taking private credit from being a lender of last resort to a lender of first choice. And we did that by creating pathways for investors, institutional investors, and then we were very early in pioneering the wealth opportunity, individuals participating as true peers. Insurance is the third. Insurance is that third leg that allows us to tailor an access point for people that likewise want durable income, inflation-protected solutions. And at the end of the day, that's what private credit is. It's about creating durable solutions that generate an inflation-protected income stream.
Marc, got to ask you, everyone is chasing the insurance industry to help them put that money and cash to work. Having said that, regulators are a little bit worried. Why shouldn't we be worried about that and the involvement of private credit?
So Blue Owl is helping solve exactly perhaps that question, that quandary. Look, I think there's a lot of wonderful protections built around the insurance industry as is, and there's a lot of regulations built around what all of us do in this ecosystem. With that said, I should highlight that Blue Owl's approach, and part of what took us a while to take this step with regard to insurance, was finding something that was really distinctive. And what for us is distinctive is we're not getting into the insurance business. In fact, our partnership with Couvert is allowing Couvert to refocus all their time and energy on liability management and insurance and not on the asset management side, and allow us to focus on asset management and not bringing ourselves into the insurance business, which is not our core competence. So it's actually going kind of the other way, which is why don't we all do what we're really good at and focus our time and energy in that spot.
Having said that, what are the conversations that you're having with Couvert about how they want to see that money managed?
That's what any good partnership looks like, right? It's a dialogue. It's about working together on a common goal. And the beauty of that DNA I talked about with Blue Owl, our DNA is built around risk reduction, stability, and principal protection. But together we tailor what's that model, what's that allocation look like? And then they say, listen, your job, and hopefully we're good at asset management, you go do that so we can be the best insurance company out there. So it's really a very wise strategic choice, I think, that allows them to do what they're great at and allows us to do what we're great at.
Talk about the relationship right now that we're seeing with private credit managers, alternative asset managers, and the more traditional banks.
So people often like to set this up as a competition, what's happening in these fights. And I actually think that misses the more complete and important underlying principle, which is we in this country, globally, but this country has the most vibrant capital markets there are, and we need liquid markets and we need private markets. And a lot of people like to argue about the pluses and minuses to every hammer, everything looks like a nail, but the truth is, to have a vibrant economy, you need durable private solutions, and there's a big role that we provide, and you need durable liquid markets, and there's a big role the liquid markets provide.
Is the private side, is that providing the liquidity to the public market?
The private side is providing the durability to the market as a whole. I've been in alternative investments for nearly 30 years. And you go back 30 years ago, the alternative investments wasn't even a term. Private equity wasn't a term, but say LBOs or other things like it, highly opportunistic, right? It was public markets would do almost everything, and then we'd show up and do one thing and disappear, show up and do one thing and disappear. We were the opportunistic market. 30 years later, it's flipped. The private markets, what we do, we've been providers of capital all through COVID, all through when the Ukraine war started, inflation raged, when we had problems in the regional banks. Every step of the way, Blue Owl provided credit. And the public market is the one that's become the high amplitude in and out provider.
But do you really feel like the private markets have been tested yet, especially if you think how much they've grown in just the last couple of years?
They have been tested. And this is one of those, hey, you never know sort of arguments that I'd say the antagonists sometimes like to make. We do know. We have decades of information on credit performance. The difference this time versus any other credit moment is we, as private lenders, have long-dated capital, so we will not have the liquidity mismatch that has often driven credit market problems. We've done more underwriting. We have stricter credit documents. We have lower loan-to-value. The one thing I think we can deduce from all the data, private credit will hold up better during the next downturn.
That's Blue Owl co-founder and co-CEO Marc Lipschultz from the Beverly Hilton in LA for the annual Milken Institute Global Conference. And for our last conversation, we talk healthcare and medicine. Dr. Ali Rezai has been pioneering groundbreaking research in Alzheimer's disease and drug addiction at the West Virginia University Rockefeller Neuroscience Institute. Dr. Rezai is the Institute's executive director and a renowned neurosurgeon and neuroscientist. He sat down with Carolyn Romaine to discuss how the RNI is leading the world in tackling two big public health issues, dementia and addiction.
You've been studying the brain, neuroscience, neurology for a long time, many decades. How much have we learned about the brain and its connection to maybe future healthcare treatments? How much more do we have to learn?
So neurological conditions are growing as the population is aging, and we have more people with Alzheimer's disease, more addiction, people with ALS, people with different types of dementias, and we need to find solutions, and we need to work together between industry, public, private sector, in the same way we came up with the solution for COVID, with the COVID vaccine. We need to build teams together that are accelerating the pace of discovery, because Alzheimer's is not going away, addiction is not going away, and we need to find solutions quickly.
Well, the pharmaceutical industry is really trying to find solutions for Alzheimer's. You have figured out something, and also with addiction, and it's using, I'm going to be very basic, but sonograms. So talk to us a little bit about the work you were doing.
So we're using ultrasound technology, and this has been universally there when you look at a baby in a room.
Ultrasound, I should say, yeah.
Exactly. So it's one ultrasound looks at a baby in a room, or for heart doing echocardiography. In this case, we have 1,000 ultrasound probes that we're delivering the energy that goes through your hair, through your scalp, to different parts of the brain, and converging in different parts to stop the tremor from Parkinson's, to open the blood-brain barrier so more drugs can get into the problem area, or to reset parts of the brain involved with substance use disorder and addiction. So the application...
Which hasn't been happening before with Alzheimer's, right? Because the drugs, they don't penetrate quickly enough.
Exactly. So we have good pharmaceuticals industry is doing a great job in accelerating discovery, so drugs are able to go in, but 99% of the drugs have difficulty crossing a blood-brain barrier, which is in your brain's blood vessels, and that's why you have to give higher doses, more frequency, and long-term drugs. But what if now we can open the blood-brain barrier non-invasively with an outpatient procedure temporarily, to allow much more drugs to get into the area where the problem is. And that can potentially help really accelerate and make drugs even more effective and safer.
How close are we to that, to seeing that actually deployed?
We and other groups have demonstrated that, where we can non-invasively, for example, somebody with Alzheimer's, they have this protein buildup in the brain. So we can open the blood-brain barrier in the areas with beta amyloid plaques and then deliver the antibody. So now the antibody can get in faster because the barrier is open, and then do its job. So we found that in initial study that we can increase the removal of these plaques by 53% more as compared to antibody alone.
Is that going to be effective on people who are in advanced stages of Alzheimer's, or is this only going to work on people who are maybe at the early stages?
Right now, studies for very early stage, but this has potential for Parkinson's, for people with frontotemporal dementias, ALS, and many other conditions. So we think this is important for the pharmaceutical industry and partnership to now provide a new way where we can deliver the drugs to the brain, to the problem area exactly where it is, here deliver the payload, and then it closes, so the drugs can become more safe and more effective potentially.
Dr. Rezai, Alzheimer's is one thing, addiction is another one, and we probably all know someone who's had to deal with addiction on some level. Tell us about the same kind of treatment, similar, or I should say, that's also being effective when it comes to addiction.
Yes, so the same technology is being used. There's a part of your brain, deep in the brain, that is your addiction center, reward center. So this country is having a big problem with substance use disorders, fentanyl, heroin, cocaine, meth, and there are more than 40 million people with substance use disorders. So The solutions can be effective, but they're not good enough. Last year, sadly, 110,000 people died from overdoses, and it's only getting worse. So we need to explore new technologies and partnership with science and industry to help people with addiction. And the work that we did, we're able to show initially that we can deliver the ultrasound beam and reset the brain, the craving parts of the brain, so the cravings are dramatically reduced, and people are now able to deal with addiction and the cravings better, and are not taking as much drugs. So we're very excited about this opportunity.
I do think about here at Milken, right? It's all about capital, lots of money here, investing, going to different places, capital flows and medicine and treatments and discovery.
Yes.
Tell us what you are seeing on that front and what more you would like to see.
So what I discussed with you about Alzheimer's work and the addiction, it was all developed by philanthropy and foundations giving us the seed capital. And that seed capital raises all the other sectors coming in. It's only with combining philanthropy with science and technical expertise, industry, government all together. Once they come together, magic can happen.
That's Dr. Ali Rezai, Executive Director of the West Virginia University Rockefeller Neuroscience Institute, speaking with Carol Massar and Romaine Bostick from the Milken Institute Global Conference in LA. And that does it for this special weekend edition of Bloomberg Businessweek. I'm Tim Stenovec. Stay with us. Today's top stories and global business headlines are coming up right now.